رب زدني علما.
Okay. So last lecture, actually what we did, we started the tangible non-current asset, like the standards which are related to tangible non-current assets. I'll be quickly reviewing this one because we'll not be having time to
Yeah,
revise
please.
all
Yes,
that. Yeah, yeah. So
yes.
the major international accounting standards which cover tangible non-current assets are basically IS 16, which is related to property, plant, and equipment, which is actually a major chunk of all the financial statements and all that, which covers recognition, depreciation, revaluation, and changes in the methods. Then we have IS 23, which today we'll be starting, that is related to borrowing cost. Then we have IS 20, which is related to government grants. We have IS 40, that is investment property. And I missed over here one, that is IS 36, which is related to impairments. Okay. So we studied the classification of assets, like that is normally in financial statements we do classify on basis of physical existence, which is tangible and intangible assets, right? There is also
Yes,
a classification of convertibility, which is related to liquidity, current assets, and
yes,
non-current assets. Then we have
yes,
on the basis of
yes,
usage, that is operating assets, non-operating assets. Then we have also
yes,
a classification based on IFRS and GAAP, which is financial assets and non-financial assets. In one of my interview as an instructor, they asked me actually that assets are classified into non-current and current, then tangible and intangible. What else the classification can be for the assets? So that was financial assets and non-financial assets. And on financial assets, there is a three. Before that, there were four international accounting standard and IFRS, which were basically IAS 32, IAS 39, IFRS 5, and IFRS 9. Now, IAS 39 has been overruled by IFRS 5 and IFRS 9. So, we'll be studying these three international accounting standards on financial assets as well. Then, there is also by investment and then special classification. We studied that the basic difference between capital expenditure and revenue expenditure, which is called capex and revenue expenditure. Basically, we studied that whenever company needs, like, in we connected it with the first lecture where we studied that the taviz of the financial statement elements, that whenever the asset will be going up, we'll record it through debit, we recognize it through debit, and
yes,
whenever expenses goes up, we record it through debit. Okay. So actually,
yes,
if we see there is a connection between both, like if asset is increasing or expense is increasing, we record it through debit. It means they have the same nature. Why they have
yes,
same
true.
nature? Why they have same nature? See, I put in last lecture, I put a scenario in front of that other candidate. I said, okay, we need a we need a transport service for our, let's say, staff. Now we have two options. Option one is we get transport services or coaster on rent, to whom we'll be paying rent on monthly basis, or we can buy our own coaster, right? In either case,
Yes,
we are getting the benefit. And what is the benefit? Benefit is we are getting the transport services.
transportation.
Yeah.
Yes,
Now, in one scenario, if we are paying a rent, we say that, okay, rent will be charged into the income statement because it is an expense. And on
yes,
the other hand, when we are buying an asset, when we are buying that coaster, we are saying that is our asset. Take it to the balance sheet. Why it is so? Why there is a difference? So the difference is both are basically expenditures, but the first expenditure, which is basically we are getting a transport on a rent service, that is giving you benefit for less than 1 year. Like on monthly basis it is giving you benefit, while on the other side when you are buying a coaster, the expenditure spent on buying that coaster will be giving you benefit for more than 1 year. So
true.
in accounting, we say that any expenditure which will be giving you a benefit for more than 1 year, we capitalize that expenditure. And when we capitalize that expenditure, that capitalization is called making an asset or recording an asset in your balance sheet. This is basically the story behind all the expenditure being capitalized and classified as an asset, right? On the other hand,
Correct.
any expenditure which will be of short term of the nature, it will be operating nature, which will be giving you benefit for less than 1 year, and operation nature, that will be classified as revenue expenditure. So capital expenditure is expenditure which will be spent or which will be incurred, and it will be giving you benefit for more than 1 year. So what we do, we capitalize it, we take it into our balance sheet, and on yearly basis we spread it, and this process is called depreciation. Okay,
Depreciation.
so
Yes.
capital asset, when capital expenditure is evenly spread or systematically spread over the useful life of the asset, that is called depreciation. I'm like quickly going through it, I'm just explaining you the main things. Okay, so
Yes.
it says that how we should be initially measure that expenditure. So very simple thing, that is a common sense. Initial recognition will be, or initial measurement will be, all the cost incurred in bringing that asset into its present location and in working condition, right? all
Yes.
the all the expenditure incurred on the that asset to bring that asset into a working condition and on the present location. So that all expenditure, when we'll be adding them together, that will give you the total cost of that asset. Now, one thing which we normally miss, that is its dismantling cost. If the asset is of that nature, if that asset is say plant, and that plant will be dismantled after 5 years, so it says that IS 16 says that you should find out the present value of that future value which will be spent in fifth year, and then you will be adding it back right now in the cost of the asset. So that is called basically the dismantling cost. We what we do, we find out the present value of dismantling cost, and then we add it into the cost of the asset to initially recognize it. Okay, then we add over here the examples. If you have any question on these things, I'm quickly going through it, so you can ask. Subsequent expenditure, it says that any subsequent expenditure later on, if it will be enhancing the working or earning capacity of that asset, then it will be added into the cost of asset. The cost of asset will further be increased. If it is not enhancing the earning capacity of that asset, so we'll just be expensing it out into the income statement. Depreciation, we already had an idea what is depreciation.
Yes.
Depreciation is systematically spreading the cost of asset over the useful life. Like definitely in case of coaster, that coaster will be usually used for 5 years. So
Yes.
what we'll do, we'll spread the cost of that coaster over the 5 years, and we'll be bringing each 1 year, like whatever the 1 year portion will be, the cost of the asset will be bringing into the income statement. That is called depreciation. So systematic allocation of the cost of asset is called depreciation. Then we had the review of useful life and residual value. See, whenever the asset is bought, uh, there is like there is certain thing which is its cost, because that will be historical cost, or in case of dismantling, that will be the future cost, but that will be probable future cost. So that is, there is no judgment involved in that, but there are judgments involved in that. In what cases, when you decide the life of the asset and when you decide the residual value of the asset. So these are two judgments which are, or these are two estimates which are being made when the asset is being recorded in the financial statements. So it may happen that initially when you record that asset, you said that we'll be using it for 5 years, and the asset will be sold for say $100 or 100 dirhams after 5 years. But later on, after 1 year, with the economic condition, with the operating condition, you find out that this asset can further be used for 5 more years. Rather than only using it for 5 years, it can be used for 10 years. And after 10 years, there will be no residual value. So perfectly all right. IAS International Accounting Standard allows you to revise the estimates as far as there is an revision of the estimate. If there is revision of the value of the asset, then that is not allowed. That is allowed in the revaluation, and that is called basically change in policy. There is another standard on it. We'll be studying that standard and we'll be covering all those things over there. Over here, we only just have to focus that yes, international accounting standards allow if there is change in useful life and residual values, if there is change in judgments, in simple. Then,
Quick interruption.
yes,
Sorry.
yes, please go ahead.
This dismantling.
Yes, yes.
Oh, we have many plants in my company,
Okay.
and in the past also I noticed that we never touch this one, dismantling cost
Oh,
or something. Why we do like that? I mean, we never touch
okay. So
before
actually,
the
it should be touched.
yes,
Okay, let me open an Excel sheet. I'll be letting you explain over here. Okay, can you see my Excel sheet?
yes,
Let's suppose like we calculate the cost of the asset. Okay, over here. We'll
yeah, we
have
got the yes,
we have the major chunks. Let's suppose we say that purchase price.
okay,
Okay,
yes,
we'll have major chunks. Okay, so purchase price was, let's suppose I'm just putting a random figure, that is
yeah,
200,000. Okay,
yes,
okay. Then we had say
yeah,
freight cost. Let's suppose,
yes,
okay, we had a freight cost. Okay, let's suppose that was 10,000.
yes.
Okay. Then we had say let's suppose sampling test.
Installation or yeah, sampling, yes,
Sampling test, for example, that is 10,000. Then we have say installation and etc.
yeah, yeah.
Installation,
Yeah, in case of import, we have duty and
that
all,
is duty, and
import
that
duty
is
and things.
covered
Yes,
in freight costs. Okay,
freight cost, yeah, freight and everything. Yes,
yeah, that
yes,
is covered in that one. Okay, so we have, let's
yeah,
suppose 30,000. I'm just putting over here 30,000. Now these all costs are present cost which
yes,
actually incurred. Okay,
yes,
but what will happen, the plant you are using or you are installing that plant, definitely after it has been used, it will be dismantled, isn't it?
mm,
Like, let's suppose let's talk about the ships,
yes,
like the ships which have like which goes into the sea for drilling.
yes. Every plant has a kind of, we can say that I mean maximum life.
Yeah,
After that,
after that that will be dismantled.
yes, true,
Okay, now if that will be dismantled, there will be a cost,
of course,
right? So
yes,
how, but that will be a future cost. So we judge it, let's
yeah,
suppose we say that in future after 5 years, let's suppose in after 5 years, the cost of dismantling will be 50,000.
mm,
Okay, but now this is, let me write it over here rather than over here. Let me write it over here. This is a future cost, this is not a present cost.
yes, future cost,
This is a future value, this is not today. These are only today's costs, these are present values.
present
Now
value, yes,
in future it may happen, not it may happen, it actually happens. Like the dirham today is not the same value of dirham tomorrow,
yes,
right? Like
yes,
the dirham which from one dirham, the things you can purchase 5 years ago, today you cannot purchase the same things with the same dirham.
true,
Okay, so they say that this is the future cost. What you should do, you should present it. How you present it? We present it by using the present value formula, that is 50,000 divided by 1 plus R, that is interest rate, and we raise to power whatever the number of years are.
yeah, number of years, yes,
Okay, so
yes,
now actually there is a term. Now you do it, for example, if I calculate it over here, so that will be 50,000 divided by 1. Let me calculate it over here. 1 point. Let's suppose the interest rate is 10%. Let's suppose, right?
yeah, yeah,
And
yeah,
we have, let's say, we have 5 years. After 5 years, like this is after 5 years. So what we get
yeah,
over here,
easy.
let me calculate it over here. This will be, just a minute, 1.10 raised to power 1.10 raised to power 5. This will be 50,000 divided by 1.61051. So today you will be giving the cost which you will be paying in future after 5 years, that is equal to 34,106 today.
Yes,
Right?
yeah.
Now, what you have
Yes.
done, you have recorded into the cost. You said that this is included in cost, but that is not the actual value. This value you will be paying in future.
Future.
So how you do it, you actually record it as on one side, you say debit asset, and on other side, you are not paying other costs. These are the costs you are actually paying.
Yes.
You are paying as a cash or bank or whatever. But this cost you are
Whatever.
not paying. This cost will be paid after 5 years.
You
So
can create a liability.
yeah, you record it as liability,
Yes.
right? You record it as
Yes.
liability. Now the
Yes.
twist is,
Yes.
see, today you are recording it with 31046. And for example, I'm putting it separately.
Yeah. Just
Okay. Now the question is, after 5 years, you are not paying this amount. You will be paying this amount.
50,000.
So you need, your financial statements need to reflect how this amount has converted to this amount over the years. Now, this process is called, first of all, finding out the present value is called winding up. Now, in next 5 years, you will be unwinding up. How you will be unwinding up? For example, let me put it over here, that case. We have 1 year, we have 2 year, we have third year, we have fourth year, and then we have fifth year. At the end of the first year, what you'll do, you say that, okay, we had the liability of 131,046. But now after 1 year, there is interest as well, and that has grown to how much? 31,046 multiply by 10%. And that has
10%.
grown,
Yes.
that has grown to how much? That has grown to, I'll be putting it over here,
Interest paid.
31046 multiplied by 0.10. So at the end of the first year, sorry, this will be not 1 point, this will be 1.10, because we'll be making it a bigger
Yeah.
one.
They will
Yeah,
increase the number.
yeah,
Yes.
exactly.
Yes.
So at the end of the first year, the liability will be this one.
Yes.
Okay. Now what will happen? Second year, the liability will be this
Again,
multiplied by
plus.
1.10.
Yes.
Okay. So is equals to this, enter. And third year is equals to this,
Plus.
and
Yeah.
this multiplied by 1.10.
10.
Okay.
Yes.
Next is equals to this
1 point.
multiplied by 1.10. And then here at the end of fifth year, now see what happens. Multiply by 1.10. 50,000.
Exactly.
Right?
Yes.
So what will happen?
Yes.
Oh, this is unwinding. So at the end of the year, now what will happen? At the end of the year, you will be paying this amount. So what you will do?
Yeah.
You'll debit liability, which you
Yes.
recorded.
And we will.
You recorded, and you will credit the cash.
Cash. Yes.
Okay. Now what will happen? Initially you recorded this liability.
Yeah. True.
Okay. So that liability will be increased over the years. Every year you will be passing an entry.
Yeah. I
First of
think
all,
yes. Yes.
every year you will be passing entry debit interest, expense, and credit
And interest
liability.
payable.
Not
Interest
payable,
payable. We can say.
liability related to this asset.
Okay.
Okay,
Yes.
because that is not payable, that is liability recorded to this, basically unwinding of the interest. So every year that will be increasing with the amount of the interest, and at the end of the
Interest.
fifth year you will be debiting the liability and crediting the bank, so that the dismantle cost will be paid at that time.
True. True.
Got
Yeah.
it? But
It's similar that we have. Yes. It's similar. I think the same thing we are applying. We have a piece of land for our
okay,
factory, and under IS 16, the IS 16 says that lease nowadays. I mean, when it is implemented, I think 20, uh, 20 implemented from that year, we are calculating, this land. Two things we are calculating as a liability of this same present value and future value. We are booking an ROE, that is right of usage.
Exactly, exactly,
That is coming. That comes also under IS 16, right?
exactly. That comes under IS 16.
Right of use means we are assuming that it's not our assets; it's a lease for
Exactly.
50 years, next 50 years. But we are keeping in ROU, that is right of use. We are making an assets also, and at the same time we are, non-current liabilities and and the current liabilities we are calculating similarly this in this chart in this way.
Wasim Saab, that is, you know what? That is substance over form.
Hmm.
That is substance over form. That economic reality should be preferred over legal form.
Yes,
The legal form
the
is,
first chapter. Yeah, the first chapter. Yes,
yeah, the legal form is you don't
yes,
own that land, but you are
yes.
having the right of ownership. You are using
Right
it,
to use.
you are controlling it. That's why you are writing it in your assets.
Yes, before it was not. After IS 16 only.
Yeah, exactly.
Yes. Okay.
Done?
Okay.
Okay. So uh, for for IS 16 allows you to follow two methods. One is cost method. What is cost method? Basically, you buy the asset, you record the cost. Over the period, you calculate the depreciation. Okay, accumulated depreciation is calculated and depreciation is calculated. Fine. Other model is revenue revaluation model. What is revaluation model? They say that property, plant, and equipment may be carried at revalued amount. Yes, less any
We did this
subsequent.
as well.
Yes, that you know why revaluation model is followed. When there is a huge, say, ups and down in the value of the assets, then the
We did
revalue.
for some other purpose, but we did.
Yeah, you did.
Yeah, for some other purpose. It was, to show the, you know that.
Yeah, yeah. No, don't say
Yeah,
it because it's being
yeah,
recorded.
yeah, yeah, yeah. That's also.
Yeah,
Yeah,
got
yeah,
it,
no.
got
Okay.
it,
Yeah, yeah.
got it. No
Okay.
issues. So
Yeah.
actually, once that
But it's
reval,
extensive. It's a very extensive kind of job. It's
it
not
it
simple.
it is very
Yeah.
extensive.
Yes.
Okay,
That's good.
so revaluation model is also there. We can do the revaluation, but what happens if the revaluation model is applied? So every year that class of the asset should be revalued and revalued, and that should be stated on the revalued, because it cannot happen once you have revalued the assets and then you are coming back to the cost model. No, IS 16 doesn't allow you for that.
Okay.
Okay,
Okay.
because
Okay.
in that case there will be an audit objection.
Hmm.
Okay, in that case, there will be a audit objection. That is, it is written over here. If the revaluation alternative is adopted, two conditions must be complied with. The revaluation must subsequently be made with sufficient regularity to ensure that carrying amounts does not differ materially from the fair value of each reporting date. And when an item of the property, plant, and equipment is revalued, the entire class of assets to which item belongs must be devalued. What does it mean? It means if you are revaluing your coasters, let's suppose if you are
Yes.
revaluing your coasters, you cannot apply the revaluation only on the coasters. You should revalue all the vehicles,
Yeah.
because
Entire.
yeah,
Exactly.
entire
Yes.
class of the
Yes.
assets.
Yes.
Yeah,
Yes. Yes. Each and every assets. Each
exactly,
and every assets. Yes.
exactly. And that this is the accounting entry for that. We did it. We made it. Okay. Now, what is the important thing over here? Once you revalued your asset, so what is the basically what is the entry? Entry is you debit non-current assets, you credit debit accumulated depreciation, and you credit other comprehensive income. For example, you credit revaluation reserves. Now, revaluation reserve is part of equity. It will increase your equity. In your balance sheet, there will be increase in the equity side, there will be increase in the asset sides. So financially, you are strong, but actually, that is not realized reserve. You cannot distribute money from this reserve, right? Because this is only the reserve, or this is only the increase in the equity through a accounting adjustment, rather than actually it is being invested in the business, right? So what happened? Can you listen to me? I guess dropped. Okay, we'll be waiting for him. He'll be coming back, no issues. Hello.
Yes, sir.
Yes.
Sorry, it was
No,
disconnected. Yeah, now
no
it's
issues
okay.
at all. It's perfectly all right. See, we were discussing that yes, revaluation can be done. How you do revaluation? You debit non-current asset, you debit accumulated depreciation, and you credit revaluation surplus. What is the result of this thing? It will increase your equity side and it will increase your asset side. So on papers, your financial statement, your balance sheet will get stronger, right? But
Yes,
what is the what is the phenomena behind it? The reserve which you are increasing, which is called revaluation surplus, that is not realized reserve.
yeah,
You cannot distribute. IS 16 does not allow you to distribute from that reserve. Now, over
it will
the
just again.
yeah, it is a just again. Now
Yes,
the question is how it can be transferred from unrealized to realized. There are two ways. One, the first thing is you are using the asset for the next few years. Now you are using it. So what will happen? You will be charging the depreciation on it, right?
yes,
So that
yes.
depreciation, the new depreciation will definitely be higher than the old depreciation, right?
True.
So
Yes,
IS 16 says that whatever the excess depreciation is being charged, you should take the amount with that excess depreciation from that revaluation surplus and take it to or bring it to the retained earnings. So what will happen? It will make that surplus from unrealized to realized. Got it?
a little confused here.
Okay, no issues. Listen, now what will happen? Let me open again the Excel sheet. with the hypothetical values, right?
Yes.
So let's suppose
The
before
first question, I think, the first question, yeah, that is same, I think.
yeah. So before that revaluation, we had the depreciation per year that was 50,000, right?
Okay. Yes.
Now, after that asset has been revalued, definitely it has been. Oh, one thing, let me clear over here. When we say that revaluation, so normally we say that upward revaluation,
Yes.
but it is also possible that there is downward revaluation.
There are many. Yes. True.
Yeah,
Yes.
but that downward revaluation is not taken into the IS 16. IS 16 does not account for downward revaluation. That is treated in IS 36. That is impairment of asset. So downward revaluation is called impairment of assets.
Okay.
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 So
Got it.
when we say that revaluation, so revaluation is normally upward.
Yes.
Okay. So let's
Okay.
suppose we
Yes.
revalued the asset. Now the new depreciation is 100,000.
Okay.
Right. So
Yes.
what you did initially when you revalued asset, you created an account which was a revaluation reserve account, right?
Yes.
Now
Yes.
that revaluation reserve account is unrealized account. You cannot make distributions from that account.
True.
If you do, there will be an audit objection.
Yes.
Okay, because the thing is that is only a and that increase in the equity was just due to an adjusting entry rather than through actually putting money or
It's not
putting
cash
resources.
organically. Yes. Yes.
Exactly,
Yes.
right? Now what it says that there are two ways that unrealized will be realized, will be converted into realized. The first one is through using the asset. Now there is
Mhm.
you had used the asset 1 year after the revaluation. There the old depreciation would have been 50,000. The new depreciation is 100,000. What is the excess depreciation? Excess depreciation is 50,000,
50. Yes.
right? So what it
Yes.
says that with this amount, this 50,000, what you will do, you debit your revaluation reserves, and you credit retained earnings.
Okay.
Retained earnings. Now, what you are doing, actually, they both are part of equity, but retained earnings are realized reserves, while revaluation are unrealized reserves. So, with the excess depreciation, you took that 50,000 from revaluation reserve and you credited to the retained earning. Now, 50,000 from the revaluation reserve has been transferred to retained earnings, and now it has become the realized reserves of 50,000. Now you can use it for distribution.
Got it.
Got it?
It's clear.
Or
Yes. Clear.
otherwise, the second way when you will be selling the asset after revaluation,
Yes. That is
right?
also one case. Yes.
Now let's suppose the asset was, let's suppose I'm putting hypothetical figures now. Let's suppose the asset was 100,000, you revalued it to 500,000, right?
Yes.
The carrying value,
Hmm.
I'm saying, the carrying value of the asset was 100,000 and you revalued it to 500,000. So you actually credited the revaluation reserve with 400,000,
Yes.
right? So once that asset is
Yeah.
being once the asset is being sold, so whatever left in the revaluation reserve, you will be debiting it and you will be shifting it to the retained earnings.
Okay.
Got it?
Okay. Okay.
So
For that particular assets.
exactly, because now the asset has been sold. Now, if the asset has been
Yes.
sold, you have received cash or you will be receiving cash against the revalued amount. So now it has been converted into the realized rather than unrealized.
Yes.
Okay, so there are only two
Yes.
ways that revaluation, the unrealized reserves can be transferred to realized. One is through depreciation. The asset is being used, the excess depreciation is transferred to retained earnings, or the asset is being sold. Now, if the asset is being sold, whatever the revaluation reserve, there will be no revaluation reserve now related to that asset, and that will be shifted towards the retained earnings. Right?
Perfect.
Okay. Okay.
Yes. Perfect.
So moving forward, this was related to recognizing revaluation gains and losses. Just go through it, what it says. Okay.
Yeah.
What
Yes.
else? This is written over here. How you transfer that excess depreciation from revaluation reserve to retain earnings, right? This is the entry over here
Yes.
as well. There is
Yes.
example, just go through it. Self-test example is also there. Disposal of revalued non-current asset. This is what we discussed over here. When you dispose that revalued asset, there will be you will be nullifying all the revalued revaluation surplus account related to that
To
asset,
the return.
and that will be there.
Yes.
Okay. Now, this was the basic in of IS 16. What we were studying, we just completed IS 16. Again, the revision of IS 16. Now, there are three IS which are not that much long IS, but they have connection with the tangible non-current assets. The first one is IS 20, which is related to accounting for government grants and disclosure of government grants. See, can you hear me clearly, right?
Yes. Clearly.
Yeah,
Yes.
okay,
Yes.
okay. So in a nutshell, this international accounting standard is basically applied, or this international accounting standard provide guidelines about the companies who receive government grants and government assistance, and how those government grants should be accounted for in your financial statement in case you are getting it. Now, what it says, government often provide
Mm.
money or incentives to companies to export their goods or promote local employment. This is basically giving the why governments will be providing government grants or assistance. This is straightforward thing, common sense.
Reason.
Whenever government actually wants to say boost a sector, they provide the grants. Like these grants can be directly they'll be providing money, or these grants can be they can provide you the assistance, such as they'll be saying, okay, for 5 years there will be no taxes. Okay, for 5 years there will be no electricity cost in this area, like free zones in UAE. Okay, when they were initially set up, so there were different laws in those free zones as compared to other zones, right?
Mainland. Yes.
Okay.
Different. Yes.
Now these grants actually divided into two. One, revenue grants, other are capital grants. These revenue
Yes.
and capital like nomenclature, that is same like we studied in IS 16. Revenue grants will be those towards the contribution of payroll cost, or like operational, to meet the operational expenses which grants are given, that are called revenue grants. Capital grants are basically contribution towards the purchase of non-current assets, or capital grants are the grants which are given to meet the capital expenditures, right? So
Yes.
IS 20 basically follows two principles. One is prudence, one is accruals. What is prudence? Prudence says grant should not be recognized until the condition for the receipt has been complied with and there is reasonable assurance that grant will be received. Normally, when we talk about the prudence concept in accounting, so prudence concept and prudence with the conservatism of accountancy that comes with it, this is that you should not record your profits or your gains until you have received it, or you are probable that you will be receiving it, and you should not overestimate these profits or gains. On the vice versa, they said that if you have the possibility of the expenses, you should record it, and you should not underestimate the expenses. Following that prudence concept, it says that grants should never ever be recognized until the condition for the receipt have been complied with. Definitely, the government will be giving you grant for fulfilling something. Like, for example, they want to increase the employment. So, if you
Yes.
will be generating employment, then they will be giving you grant.
Yes.
Or if they have promised to give you grant, or they have given you grant, you should never recognize it until you have complied with all the conditions, right? The second
True.
one, accruals. Grants should be matched with the expenditure toward which they were intended to contribute. If government is giving you grant for increasing the employment, you should only use that grant towards the payroll costs rather than using it for
Yes.
other costs, right? So
Yes. USA. Yes.
if you will be using that thing, that grant, for some other purpose, definitely there will be audit objection,
Yes.
right?
True.
So these all,
Yes.
basically, what is the purpose of these all international accounting standards? The purpose is to avoid those audit objections and to provide the relevant and faithful information. Now, how the revenue grant should be treated? The recognition of grant will depend on the circumstances. If the grant is paid when the evidence is produced that certain expenditure has been incurred, the grant should be matched with the expenditure. Simple. If you have already incurred the expenditure and then you are receiving the grant, whatever expenditure you have incurred, you can set off with that expenditure, the revenue grants. Other one, if the grant is paid on different bases like achievement of non-financial objectives such as creation of specified number of new jobs, grant should be matched with the identifiable cost of achieving the objectives. So for example, you are given the task to increase the employment up to 100 employee in this period, in this 12 months. So once you have achieved 50, you can match that 50 employee grant with that expenditure. You should not match the
Okay.
other one, right? So if that is
Yes.
this is the simple one. So how you should be
Yeah.
present that revenue grants. IS 20 allows such grants to either be presented as credit in statement of profit or loss or deducted from related expenses. Now, what does it mean? See, you were talking in the previous meeting that you revalued for other purpose and all that. This is basically the what I should say, the cushion is provided for these kind of things. They are giving you two choices. One, presented as a credit in statement of profit and loss, like you will be presenting it as an other income,
Yes.
right? This is one way. Other way, they are saying deduct it from the related expense. You have incurred that expense, you are receiving the grant, you
Yes.
deduct it, you set off whatever the remaining expense will be there, you report it.
Yes.
Okay, now in
True.
both cases, these can be used for the manipulation purpose or for the discretion of the manager of that accounts, right? If
Yes.
that in first case, if the manager wants to show higher income, so that the
You
first
will show
method
the
will be,
income. Yes.
got it,
Yes.
and other one
Yes.
will
Sure.
be different. But in either case, it will not be having any impact on the net profits. This will only be
Yes.
having, it will be only be having impact on the line items of the financial statement rather than the total, the final one, right?
Presentation. Yes.
Yeah,
Only. Yes.
yeah. So presentation as in credit in statement of profit and loss. There are basically sporters on this one. The sporters of this method claim that it is inappropriate to net income and expense item, and that separation of a grant from the expense facilitate comparison with other expenses not affected by grant. While deduction from the related expenses, the supporters say that it is argued that with this method, expense might well not have incurred by the entity if the grant had not been available. So presentation of the expense without offsetting the grant may therefore be misleading. So both are the acceptable arguments, and this is the choice of the manager or the company which they use, and there cannot be an audit objection on this one, right?
Yes.
Now, the other one, the big one, is capital grant. Capital grant is given to meet the capital expenditures. Again, IS 20 permits two methods. One is write off the grant against the cost of non-current asset and depreciate the reduced cost. Whatever the rest of the cost will be there, you will be depreciating that cost. Simple. The other method is treat that grant as deferred credit and transfer a portion of revenue each year, so offsetting the higher depreciation charge on the original cost. So in that case, what will be happening whenever you will be receiving that grant or it will be receivable, you will be taking it as a liability. Okay,
Yes.
liability in your balance sheet. So
Yeah.
every,
Different. Yes.
yeah, every year you will be bringing it as your revenue. You will be crediting your revenue and debiting the liability, reducing the liability, increasing the revenue, and that will be met the cost of the asset, which is spread over the years. We'll do one example on this one as well, the practical example. IS 20 permits two treatments. Both treatments are equally acceptable and capable of giving fair value. One, the both method we have already discussed, like initial recognition, deduct the grant from the cost of asset. The second one is grant initially recognized as deferred income, then taking it into your revenues. We'll do the example of this one. An entity
Yes.
opens a new factory and receive a government grant of $15,000 in respect of the capital equipment costing 100,000. It depreciate all plant and machinery at 20% straight line. Show the statement of profit and loss and statement of financial position extracts in respect of the grant in the first year under both methods. Okay, so in first method, what will happen? Let me open my Excel sheet. First method says that deduct it from the cost of asset, right? So what is the
Yes.
cost of asset? Cost of asset was 100,000. Grant is 15,000.
Yes.
So in method one, what we'll do, this is method one. Let me write method one. So net amount will be,
55.
yeah, net amount will be 85. Now onward, what we'll do, we'll depreciate this amount. So first year, if we say that, what will be the extract of, just a minute. If we say what will be the extract of statement of profit and loss. So there will be a depreciation first year, depreciation expense of definitely 85,000 is being depreciated over 5 years at 20%. So this will be percentage, just a minute.
Right.
So this will be 17,000. That's it, right?
Yes.
So entry will be depreciation expense debit, accumulated depreciation will be credit, and what will be what will be extract of statement of financial position, FP, that will be non-current asset, will be reported at 68,000 because it is reported at carrying value, right? So that will be
Yes.
85,000 minus accumulated depreciation. Right now, depreciation or accumulated depreciation is 17,000.
Yes.
So this will be method
Yes.
one, right?
Yes.
While in
Yes.
method two, they say that record it as a credit. Like 15,000, what you are receiving, you will be passing an entry. What entry it will be? Debit, liability. Sorry, you will be receiving
Deferred value.
cash. For example, debit bank,
Yes.
15,000. And what will the credit? Credit will be liability related to government grant,
Yes.
right? 15,000.
Yes.
So this will be initial recognition. Now, after 1 year, what will be the extract? Extract of statement of profit and loss will be depreciation expense will be 100,000 multiplied by 20%. That will be 20,000. Original depreciation will be calculated on original cost, and there will be revenue from government grants. That will be how much? That will be 15,000. So in basically the asset have 5 years of life.
5 years.
So
Oh, yeah.
5 year. So
Yes.
we'll be recognizing that government grants over the 5 years. So 15,000 divided by, or we can say multiply by 20%. So this will be
3,000.
3,000. Now you can
Yes.
do, see, that's either case. You can put it as negative, this one, and that will be positive. The other one will be the positive, right? Because that is, now what will be the entry? Basically, every year revenue from the government grant will be credited and liability related to government grant will be debited. So over the 5 years, liability will be nullified and that
Adjust.
will be transferred to the revenues, right?
Yes. Yes. Yes.
So what will be the extract of statement of financial position? So extract of financial position will be NCA will be 100,000 minus 20,000. So that will be
80.
80,000.
Yes.
While we'll be having non-current liability, and we'll have current liability as well. Okay, we'll do not do non-current
No.
liability. We'll only do right now non-current liability. Well, it will be the non-current liability. Actually, I should do this one. There will be non-current liability of 9,000. There will be current liability of 3,000. Right? The total is 12,000. 3,000 has already been taken to the revenues. The total is 12,000 liability. But from that 12,000, 3,000 will be converted to revenue within 1 year. That's why we are recognizing it as current liability, and the rest of the 9,000 will be non-current liability.
Yes.
Got it or not?
Here,
No?
okay, one more time. Okay.
Oh, no issues, no issues. See, this is, let's
This
suppose,
question only. Yeah.
this is, for example, this is to 2024.
Yes.
Okay, at the end of 2024, we had 15,000, we had taken 3,000 from 15,000, and we have taken to the revenues. Now the rest of liability is 12,000. Agreed?
12,000. Yes.
Agreed. Now we are on 31st December 2024. The total liability is 12,000, right?
Yes.
Yeah.
And 3,000 is current liability. Yeah, got it. Yes.
Got it. So 3,000 will
Yes.
be converted into revenues within 1 year. That's why 3,000
Yes.
is current and 9,000 is non-current.
Yeah, got it. Yes.
Got it. So
Yeah, clear.
this is basically the example, both methods. Now they are saying repayment of grants. When the grants are repaid, in some cases grants may need to be repaid if the condition of the grant are breached. If there is an obligation to repay the grant and the repayment is probable, then it should be provided for in accordance with IS 2037. There is IS 37. What is provided? Provision. We create a provision. When we'll be doing IS 37, we'll go through it. Okay. If the deferred income method for capital grants has been used, which we did recently, then the remaining grant would be repaid to the government. Remaining grant, let's suppose 12,000, that will be paid. Any amount released to profit or loss may also need to be reversed depending on the level of repayment required. If they say that all the grant will be repaid, so you have to reverse the revenue portion as well, right?
Yes. Oh, yes.
If netting off method for the capital grant has been used, then the cost of the asset must be increased to recognize the full cost of the asset without the grant, and liability will be set up for the grant repayment. This was related to IS 20, right?
Yes, 20.
Now
Yes.
we'll be going to the IS 23, which is related to borrowing cost, right? Now, what is
Yes.
that? What is borrowing cost in a nutshell, in a summary? See, if if an entity borrows some money to build a non-current asset, right? To build some building, let's suppose. So on that borrowed money, they are paying interest, right?
Yes.
I have a question. Why they are paying interest on that borrowed money? Because they are building a building,
Yes.
right? So if they are building a building and for that they borrowed money and they are paying interest on that thing, so IS 23 says if that interest is being paid for the purpose of building that building or building that asset, then that interest amount should also be capitalized, should also be the part of the cost of that non-current asset. Got it?
Yes.
This is
Yes.
this is basically the IS 23 in a nutshell.
Got it. Yes.
But now it defines only few assets on which IS allows that interest should be capitalized, when the capitalization should be started, and when the capitalization should be ceased. All the rules we'll be studying, going through quickly, right? So IS 23, but in nutshell, this is very simple. The interest paid on the borrowed amount for specified non-current assets should be capitalized in the cost of the asset, because IS 16 says the cost of asset includes all the expenditure to bring that asset into working condition at it and it's on its present location. So the interest cost is being incurred because of that asset being built, right?
True. 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 Yes.
So that is in nutshell. So IS 23 borrowing cost regulates the extent to which entities are allowed to capitalize borrowing cost incurred on money borrowed to finance acquisition of certain assets. Now, what are those certain assets? Certain assets are basically qualifying assets. Now, what are the qualifying assets? They say that qualifying assets are those which necessarily takes a substantial period of time to get ready for its intended use or sale. Means it will not be some kind of asset which you will be directly purchasing. Only those
Got it.
assets,
Yes. Yes.
only capitalization of interest will be allowed for those assets which will be which will take substantial period of time to get ready, and those assets will called qualifying assets, right? So commencement of capitalization, it says when you should start that capitalization. IS 23 states that capitalization of borrowing cost should commence when all of the following conditions are met. One, expenditure for asset is being incurred, borrowing costs are being incurred, and activities that are necessary to prepare that assets of its intended use or sale are in progress. So this is common sense. They say that if
Yeah.
three things will be fulfilled, you should start capitalizing it. One, the asset is being like being built or the expenditure are being incurred. Second,
Yes.
borrowing costs are being incurred, and third one, the activities are being in progress. Where the funds are borrowed specifically to acquire a qualifying asset, borrowing costs which may be capitalized are those actually incurred, less any investment income on temporary investment of the borrowing during the capitalization period. Now, this is very like interesting thing. It may happen. See, you have borrowed like an entity have borrowed money for 1.5 years, right? To build
Okay.
a supermarket. Let's suppose.
Yes.
Now,
Okay.
it will not happen that all of the money will be spent at once.
Yes,
That
sorry. I'm time.
yeah, that money will be released by the over the time of 1.5 years. So
Yes.
managers may think that funds are available, let's invest those funds into short term investments.
Mm.
So let's suppose the entity has borrowed at 10% and they have invested at 4%. So IS 23 says that you should set off that 4 and 10%, and now you will be only capitalizing the 6% of the borrowing cost rather than 10% of the borrowing cost.
Because you did not use the
Yes, because you use that money to earn for further money.
profit. Yes.
Okay, so actually the actual interest rate is not 10% which you are paying. Actually, you were paying 10%, but you are earning 4% by using those funds. So net off is 6%. You are the cost of those funds is 6% to you. So you should only
So the best.
recognize 6%.
So the best practice we should use 100%.
Exactly.
Why should we use and get the advantage and then set off with the profit with the interest? So 100% we'll use and just should be capitalized.
Exactly. Right? So it says
Yeah.
that Wilson received an $18 million 5% loan on 1st January 2018 to finance the construction of new factory. Let's write it. Let's write the facts. Okay, when they got the money on 18 million 5% on 1st January. Okay. So 1st January 2018, 18 million, and how much at 5%, right?
Yes.
As the funds were not all required immediately, Wilson invested 6 million out of 18 million in 2% bonds until 31st May 2018. Okay. So from 1st January, I'll write 1st January 2018 to 31st May 2018, 6 million are invested
Yes.
at 2%,
Yes.
right?
Yes.
So they say that construction of factory began on 1st March and was completed on 31st December 2018. Okay. So from 31st March 2018 to 31st
December
December 2018
20.
construction. Okay, so it is
Yes.
almost how much? 9
Sorry.
months, right?
Yes. Almost.
9 months. So actually, rather than now on this point, the commencement should start.
Yes.
Commencement, right? Because
Yes.
commencement of the borrowing cost
Yes.
should be started from the time when the activities has actually been started. So building started from 31st March, right?
Yeah.
Okay.
It was on. Yeah.
Sorry, 1st March, not 31st
It
March.
was first month. In fact, yeah.
First March,
So
first March.
first.
So these are 10 months, not 9 months,
Yeah. Okay.
right?
Okay.
Now what it says, let's read it. What is the requirement? Requirement is calculate the amount of interest to be capitalized in respect of factory as 31st December 2018. Okay, fine. So first of all, first of all, we'll calculate whole year interest, right? Whole year
Yes.
interest. Whole year interest was how much? That is 18 million multiplied by 5%, right? So this will be
Yeah, it should be 900,000.
18 million multiplied by 0
Wow.
0.05. 0 0.05. So this is the interest for whole year.
Yeah, 900,000. Yes.
Okay. This is interest for whole year. Now, interest related to borrowing cost,
Yes.
or I should write borrowing cost first of all.
Borrowing cost. Yeah.
Borrowing cost, that will be 0.9 million, because this 900,000 is
Yeah.
0.9 million,
Yeah.
multiply by 10 divided by 12, because it
Yes.
should be for 10 months,
10 months. Yes.
right? So this will
Yes.
be 900,000 multiplied by 10 divided by 12. So
100,000.
preliminary, this amount should be capitalized into the
Assets.
asset. Okay,
Yeah.
this amount should have been capitalized, and rest of the amount from 900,000, 750 should be capitalized, and 150 will be taken as finance cost into the income statement, because
Yes.
that is the cost, that is interest you are paying, that should be accounted for as an expense, right?
Yes.
But how much is allowed borrowing cost? Allowed, in fact, I write over here investment income. How much is
150.
investment income? Investment income is 6 million multiplied by 2% and
Yeah.
multiply by 5 divided by 12,
Yes.
because it was invested from 1st January till 31st May. So what is investment income? Income will be 600,000, no, 60,000,
Hmm.
and 6 million it is, multiply by 0.02 and multiply by 5 divided by 12, right? This is total investment income, right?
Yes.
Now I'm writing
Yes.
over here how much is allowed capitalization. This is the final answer. How much is allowed capitalization? See, 750,000 is for 9 months, 10 months.
10 months.
We'll subtract it. How much? 50,000,
50,000.
but not
Yes.
whole 50,000. This
Yeah.
50,000 multiply by March,
5.
April, May.
March. Yeah.
3
Yeah. 3
divided by
months.
12, right?
Yes. Yes.
So let me calculate it over here again. Control C is equals to Control V, enter. So this much is the amount which will be allowed for capitalization, right?
Yes.
Got it? So total amount was there, that was 750,000. But from that 750,000, there was investment income of 50,000, which was not basically allowed. The whole investment income was earned for 5 months. The 3 month period has been subtracted from it. Now this amount is allowed for capitalization. Any questions so far?
No, it's clear. It's netting off the, yes, investment versus, I mean, the
Yeah.
investment income versus the cost. Yes.
Yes, exactly. Just a minute. Let me. Yeah, okay. So moving forward, this is the commencement of capitalization. Now, cessation of capitalization. It says when you should cease the capitalization. This is that capitalization of borrowing cost cease when either substantially all the activities necessary to prepare qualifying asset for its intended use or sale are completed. Definitely, they borrowed it for 1 year or 1.5 year. So when we seize it, when the qualifying asset has been completed. or the construction is suspended, or it is due to industrial disputes, there are disputes or anything else, so then also this will be the capitalization will be ceased, and at that time only whatever has been capitalized, that will be capitalized, furthermore it will not be capitalized, right?
Yes.
So there is an example for you, for yourself. You can do that example for
Yeah.
yourself. We'll start IS 40 investment property in next lecture, right? We'll not do this
Okay.
lecture because it will be too much for you to take it up. And again, we'll have a quiz next in next class.
Sure.
That will be again 20 to 30 minutes. You do
Okay.
one thing. You have these notes with you.
Yes.
Whenever you get time within these days, go through to that test as well, which I gave you, which I shared the link.
Yes.
Okay,
Yes. Yes.
that
Fine.
will
Sure.
like refine your concepts.
Yes,
Okay,
sir. Yes, sir.
so
Yes.
take care,
Yes.
and any question during the years you can directly contact me on WhatsApp, right?
This was a great session.
Yeah,
Alhamdulillah. This
sure,
was
sure.
very.
Take care, take care. Allah Hafiz.
Thank you so much. Allah Hafiz.
Allah.
Allah Hafiz, sir.